Hi guys, in this video we'll be talking about ratio analysis. So if you are O-level student, A-level student, undergraduate, then let's say if you are following any professional exam, these are the fundamental ratios that you have to remember. Okay. So this video again is a brief introduction to every ratio. I'm not going to discuss in detail, but basically let's look at the equations and so on and so forth. Okay. So moving forward. First area that we need to look into is, guys, profitability ratios, right? So first ratio we have is gross profit margin. Gross profit margin is equal to gross profit divided by sales revenue into 100. Okay. So how to calculate the gross profit? Gross profit is equal to sales minus cost of sales. Okay. So what does the ratio tell, guys? Gross profit margin. What does it tell? How much is your gross profit as a percentage of your revenue? That is the meaning of your gross profit margin. Okay. Second ratio is operating profit margin. How to calculate the operating profit margin? It's equal to operating profit, or we call it PBIT, in the sense profit before interest and tax, divided by sales revenue multiplied by 100. Okay. This indicates what is the percentage of your operating profit upon your revenue, right? That's it, guys. Third ratio we have is net profit margin. Net profit or profit after tax divided by sales revenue into 100. This also, guys, if it is higher, it's considered as better. Okay. Fourth ratio we have is return on capital employed, ROCE. So return on capital employed is equal to your operating profit or PBIT divided by capital employed into 100. So what is your operating profit as a percentage of your capital employed? That is the indication of this ratio, guys. Okay. So how to calculate the capital employed? You have two methods. First method is capital is equal to total assets minus current liabilities. Okay. Another method is capital employed is equal to equity plus non-current liabilities. Regardless which method you use, guys, you will always get the same answer. Don't worry. Then fifth ratio that we have is net asset turnover. Net asset turnover, right? Net asset turnover ratio is equal to your turnover revenue divided by capital employed. Okay. Another thing that I wanted to tell is, guys, this ROCE, return on capital employed, this ratio we can get by multiplying two different ratios. What are those two ratios? One is net asset turnover, right? One is operating profit margin. So if you multiply operating profit margin by net asset turnover, you will get your ROCE. Okay. Moving on, guys. Now let's look into working capital ratios. When it comes to working capital ratios, the main ratio is current ratio. So current ratio is equal to current assets divided by current liabilities. Okay. This is an indication of your short-term liquidity, guys, right? If this is larger than 1, let's say, it's good. But it depends, guys. Depending on the scenario, depending on company, the amount of the current ratio which is considered to be as better will change. Okay. Second ratio is quick ratio, or we call it the acid test ratio. So that's equal to current assets minus inventory divided by current liabilities. Okay. Third ratio is your inventory holding period. What is inventory holding period? How much time or how much days are my inventory in my warehouse until I sell them? That is the indication of inventory holding period, guys. Okay, how much days are my inventory in my warehouse? Right? So inventory holding period is equal to 365 multiplied by inventory divided by cost of sales. Right? This inventory, you can use your year-end inventory or your average inventory as well. Okay, you can use your average inventory or your year-end inventory as well. There's no harm, guys. You can use both the methods. Okay. So here, multiplication of 365, this will give you answer in days. If you want to get your answer in weeks, you have to multiply by 52. If you want to get your answer in years, in months, you have to multiply it by 12. Okay. Then receivables collection period. How much time are my debtors taking to pay me back my money? So that is receivables collection period. It's equal to 365 multiplied by receivables divided by credit sales. Then we have payables payment period. Payables payment period in the sense, how much time am I taking to pay my payables? So it's equal to 365 multiplied by payables divided by credit purchases. If you are not given with credit purchases, let's say in an exam you don't have credit purchases figure, you can use cost of sales instead, guys. No problem, 100% correct. Now, what is this working capital cycle or operating cycle? It's an additional point that I included, guys. Okay, it's an additional point that I included. So what is this operating cycle or working capital cycle? Working capital cycle in the sense, the number of years the company has to operate without having cash, right? Without having cash, how many days, right? Or how many months, how many years? Anyway, you can get the answer. So working capital days in the sense, how much time the company can operate without having cash, right? How much time is the company operating without having cash? That is your operating cycle or working capital cycle. So it's equal to your asset days minus liability days. Simple as that. Asset days minus liability days. So asset days in the sense inventory days plus receivable days minus liability days in the sense payable days. Okay. So if your working capital cycle is lower, guys, it's good, right? It's good. Moving forward. Now let's look at long-term financial stability ratios, right? First ratio we have is gearing ratio. So gearing ratio is equal to long-term debt divided by equity capital, right? Another way to calculate the same gearing ratio is equal to long-term debt divided by equity capital plus long-term debt into 100 as a percentage, right? So this will give you your long-term debt as a percentage of your total finance, okay? So guys, if the company is highly geared, that indicates that the risk of the company is high, right? Higher the gearing, higher the risk, guys, okay? Then we have interest cover ratio. Interest cover ratio in the sense out of your profit before interest and tax, right? Using your profit before interest and tax, how many times can you cover your interest payments? That is your interest cover ratio. If it is higher, it is better. So interest cover ratio is equal to your profit before interest and tax divided by interest expense per year. Okay. Then we have investor ratios. Okay. Earnings per share is equal to earnings divided by number of shares. Price to earnings ratio, PE ratio, is equal to price per share divided by earnings per share. Dividend yield ratio is equal to dividend per share divided by current share price into 100. Dividend cover ratio is equal to your profit after tax divided by dividends. These ratios, guys, in and out, I will discuss in depth. Okay. I will discuss this in depth in the following videos, guys. So for now, what I would advise you to do is take some screenshots of these slides and go through the ratios and try to remember them, guys.